Good morning, everyone. Hope everyone's having a good start to their day. We got durables coming up in just about 22 minutes here, so we'll be watching that, and I'll talk a little bit more about what I have my eye on in just a little bit. Good morning, everyone. Hope everyone's having a good start to their day. We got durables coming up in just about 22 minutes here, so we'll be watching that, and I'll talk a little bit more about what I have my eye on in just a little bit. Good morning, everyone. Hope everyone's having a good start to their day. We got durables coming up in just about 22 minutes here, so we'll be watching that, and I'll talk a little bit more about what I have my eye on in just a little bit. Good morning, everyone. Hope everyone's having a good start to their day. We got durables coming up in just about 22 minutes here, so we'll be watching that, and I'll talk a little bit more about what I have my eye on in just a little bit. Good morning, everyone. Hope everyone's having a good start to their day. We got durables coming up in just about 22 minutes here, so we'll be watching that, and I'll talk a little bit more about what I have my eye on in just a little bit. Good morning, everyone. Hope everyone's having a good. Good morning, everyone. Happy Wednesday, the middle of the week. Had an interesting Tesla earnings call last night. I tuned into it, I streamed it. I found it lacking a lot of details and full of very sort of optimistic ideas about where things would go from here, including ideas that seemed not to really be grounded in reality. I thought that was a key theme, like selling compute power from cars. There's a lot of different issues with that, and they began to compare themselves with AWS and saying, "Oh, we've got all this spare compute," and it's like, okay, for one, if it's your customer's car, it's not your property. For two, that's going to diminish battery. You're going to be using charge. Three, what's the reliability of that connectivity, and how do you sell out those nodes for compute if they're only intermittently available? So the whole idea of selling spare compute from onboard computers in their cars seemed very odd, as was the self-driving fleet of sort of like this idea of we're going to become a version of Uber or Airbnb, where we're going to have this self-driving fleet of cars where our owners can just sort of lease out their cars and they'll automatically drive people around and make money and then come back to their house. We're not really anywhere near that point. I thought it was a little bit far ahead to start talking about these things when we still don't have unsupervised full self-driving really at any scale that's ready to go. But then it occurred to me as I was listening to this conference call what it
Listening to
might
comments from
really
German
be
Economy
about.
Minister Habeck expects GDP to grow
And I was
0.3% in
thinking,
2024
maybe
versus
that conference
2%
call
previously.
is a
Notes
little bit
prices have
more
fallen faster
about
than many had predicted.
uh,
Says there are
Musk
signs of
earning
a
his
slight economic upturn,
pay
and the
package.
German government sees inflation at 2.4% this year versus 2.8% previously. German government also expecting 1% of GDP next year.
So, if you think about it, his $56 billion pay package was on the line.
Noting dollar yen rising above.
So that was a key area to try to defend, right? He's really been adamant about wanting to try to get that back. He didn't take any pay in 2023. So how do you inspire the hearts and minds of your investors? Put on a circus during your conference call and talk about all the amazing plans that you have for the company, some of which are reliant on, Musk being at the helm. And I think that's more of what we were hearing. Now, it certainly helped the stock climb. I think the market heard one key thing that it really liked, and that was this idea of the cheaper models coming in early 2025. Reuters had earlier said that Tesla was walking those plans back. Musk had denied that, but nevertheless, they pushed back on that during the call, saying that those cheaper models could be something we see in early 2025. And that's important with growing competition in China and other parts of the world, other automakers getting more into the EV space. Tesla needs to have an option that's more affordable for those entry level folks. So that was one of the key things that they talked about that I think got people more optimistic. But other than that, there were a lot of things discussed during the call that just felt like they were thoroughly detached from reality. That's just my 2 cents. I mean, and I come to it with a bit of a background in technology. I have a sense as to how this stuff works, and selling compute in cars that have. I didn't really see how that would scale easily. You've got so many different issues. You've got permission issues. You've got charge issues. You've got connectivity issues. You've got interconnectivity scaling issues because these nodes are going to need to talk to each other. Just it felt highly unrealistic. And the reason that I mention that is, if they're talking about things like that during the call, it starts to, get your gears going upstairs as to what else wasn't necessarily grounded in reality. And the Uber Airbnb
And so the
self-driving thing
yen
was
weakens
another,
at the key
it was a little bit of a
155
red
level,
flag.
adding to intervention speculation.
So I'm just sort of looking at it as, this is probably going to be a pop to fade in Tesla. I'm not exactly sure when that will be the case. We'll have to wait for momentum to reverse, but nevertheless. So in just about 14 minutes here, we do have durable goods coming in. The month-over-month expectation is 2.5%. The prior reading was 1.3%. And this is another one of those economic data points that can move markets simply because it's about expectations. It's about the idea that, if we see a weaker than expected print, that could bring rates down, that could push risk up or give equities a bid. And on the other side, if you see a stronger than expected print, the opposite could happen. You could have some reconsideration about rates. They could move higher and equities could move lower. So these data points have been important, like yesterday's flash PMI data. Say what you will about PMI, whether it's relevant or helpful or not, it was a big mover. It started with the 10-year note. Equities were quick to follow, but you'll note that if you were watching 10-year note futures yesterday when PMIs printed, they just gapped up. And that was your big sign that the market's going to love this print, right? It was obviously weaker than expected. Manufacturing went back into contraction. These are things that, give the market a sense of, oh, well, things are slower than expected. Maybe the Fed can cut after all. And so we got that reflexive bid in duration and in risk assets like stocks. So we'll be watching durables with a similar focus on exactly where it comes in versus the forecast. Again, month over month, the consensus is 2.5%. The prior reading was 1.3%. That's expected in just about 13 minutes.
German Economy Minister Habeck says prospects for a pickup in the German economy are clearly brighter.
We did get AT&T earnings this morning. They had a double miss. Subscriber growth was also disappointing. So, of course, the stock is bid up about 4% pre-market. This is another one of those situations where maybe it just wasn't as bad as expected. And so that helped to provide perhaps a bit of a relief bid. If we look at skew on AT&T options going into this earnings release, it was somewhat bullish. So it wasn't necessarily like Tesla where people were very bared up into that earnings release. Nevertheless, T bid about 4% pre-market here on that double miss and disappointing subscriber growth. Boeing came in with mixed earnings. They reported revenue of 16.57 billion versus an estimate of 16.25, so beating there. But on EPS, only reporting $1.13 versus an estimate of $1.72. And negative free cash flow came in at negative 3.93 billion versus an estimate of negative 4.4 billion. Negative operating cash flow came in at negative 3.36 billion versus an estimate
iceberg alert.
of
Bell 1001.
In
negative
10 minutes time now, at the
2.77
bottom of the hour, we see the release of the US durable goods forecast to spot 5% on the prior 1 spot 3%, with a range of 5% to 0 spot 3% expected. Core durable goods forecast 0 spot 2% on the prior 0 spot 3%. For Canada, we see the release of their retail sales month over month forecast 0 spot 1% on the prior minus 0 spot 3%, with a range of 0 spot 8% to 0%, and the core retail sales month over month
Block trade and
forecast 0
ticker
spot 1% on
RTX.
the prior 0 spot 5%.
Benzinga Pro Squawk has reconnected.
So again, dollar yen retreated to around 154.98 after reaching multi-year highs at 155.17.
And going into today's trading day, we do see a market that continues to show signs of lower than what I would hope for to see in terms of hedging. Skew came down again yesterday. Positioning remains elevated by a number of different metrics. So it kind of goes back to the theme that this is still not a very well hedged market. And our naive model does show that we are still in negative gamma territory with the gamma flip estimated to be 5116 on SPX. There is a rather large level of open call positioning around 5100 as well, which could provide some resistance around that level. Overnight, German business climate data came in just a bit better than expected at 89.4 versus a forecast of 88.8 and a prior read of 87.8. The German government expects their GDP to grow 0.3% in 2024 versus a lower expectation of just 0.2% prior. They also see inflation at just 2.4% in 2024, downgrading that outlook from 2.8% previously. Nevertheless, it sounds like even with some of these improved outlooks in Germany, they are expecting a somewhat stagflationary economic regime with very slow growth and prices continuing to increase. Boeing on its less than ideal earnings also bid up 3% pre-market. So like like Tesla, like some of these others, even though they didn't really deliver, they are getting a bid. Is that a bit of a change of character from what we saw earlier this earnings season? It seems like that may be the case. After pulling back as far as they had, markets seem to be a little bit more forgiving in terms of less than ideal earnings, at least so far. We'll see what the rest of this week and next week brings. These are really the two most important weeks of Q1 earnings season. Tonight's another big night. After the close, we've got Meta, IBM, Chipotle, ServiceNow, Lam Research, Vail, Align, and a number of others reporting. All eyes on Meta after their enormous rally this year to see what they can say and what they can deliver to
In 5
potentially
minutes'
keep
time
that
now, at
going.
the bottom of the hour, see the release of the US durable goods forecast at 2.5% on the prior 1.3%, with a range of 5% to 0.3% expected. A core durable goods forecast at 0.2% on the prior 0.3%. For Canada as well, they're releasing their retail sales month over month, forecast at 0.1% on the prior minus 0.3%, with a range of 0.8% to 0% expected. Core retail sales month over month, forecast at 0.1%, prior 0.5%.
And folks,
Coming up, durable goods plus 2.5% expected for March month over month, plus 0.3% for core durable goods.
And folks, probably important to note, we also have a 5-year note auction today at 1 p.m. Yesterday's 2-year was quite well received. It had better demand than the prior auction. There was a large indirect take. There was no tail, so that was a solid auction. I gave it a B on the Discord as it came out. So we'll be watching that 5-year as well to really get a good sense as to whether that demand continues, particularly further into the belly of the curve. Yeah, sure. So someone on the Brian asks, what the significance is really of what the tweet is saying. The tweet is saying the yen has weakened past the key 155 level, adding to intervention risk. This comes from Bloomberg. And so a couple things to talk about with regards to the yen. The first is that really the Japanese central bank, despite sort of moving into zero interest rate policy away from negative interest rate policy.
GOOGL, Reuters reporting German email service to the mail files Google complaint under EU tech rules. That's GOOGL.
So there really wasn't a lot of follow through with that. They're walking this back. They're even talking about continuing to ease. This is important because the Japanese central bank owns about 55% of the country's debt. The government owns about 55% of the Japanese central bank. It's one of the few central banks you can buy shares of, by the way. You can buy their stock on the Japanese stock exchange. But what's important about this is, they've been such a big part of subsidizing Japanese government debt, participating in the ETF market. They own an enormous amount of Japanese equity ETFs as well. And so, they're really still in a much more easing posture than any central bank in the world, which means the path of least resistance for their currency, because of those differentials and the expectations of them to continue, is indeed lower. Now, this brings us to where the currency is now and the talk of intervention. Yes, they could intervene. if they do intervene, it's likely to be short-lived. It's likely to be less effective than other policies. Like, for example, if they were actually raising rates and reducing liquidity accommodation for their markets. The reason I say this is if you look at every single currency intervention in Japan's history, or really just about every one that's ever happened, they don't tend to mark bottoms. They tend to mark fadeable pops, bounces that you can essentially sell into. So in my view, what we're seeing from Japan here, if they do intervene, will just be an ephemeral pop. And the only thing that really gets their currency to have a more durable bottom would be the central bank further normalizing policy away from constantly bidding on everything that isn't nailed down or on fire. So I think that interventions, give it a day or two or three, but they can be faded. I don't see the yen bottoming until they get more serious about central bank largesse and government largesse. And remember, if you're going to buy a Japanese 10-year, you're getting like a yield of around 1%. And that doesn't even factor for currency hedging costs. So if you're a foreign investor and you're asking, okay, why would I buy a 10-year commitment to Japanese government debt when the risk is greater than 1%, the currency depreciation will be greater than 1%? What's the reason to buy it? So unless rates really start to normalize higher, you also have a lack of foreign demand. Domestic demand is supported by institutional mandates. You've got retirees and savers that are putting money in that, but it's not enough, clearly, if the Japanese central bank has to keep buying. So my thought is path of least resistance is lower, intervention can be faded. Let me know if that helps.
2.6%, 2.6%. That's higher than forecast. 2.5% with core durable goods at 0.2%, 0.2% as expected. Canada retail sales month over month minus 0.1%, minus 0.1%, lower than forecast 0.1%. Core retail sales minus 0.3%, minus 0.3%, which is lower than forecast at 0.1%.
So core durables coming in line month over month, coming in higher than expected at the headline level year over year. Market so far, not much of a reaction to this print. It wasn't so much of a deviation that I expect too strong of a reaction. If we check here on rates and we just zoom into the 10-year note futures contract, we can see not much of a reaction there either. A little bit of buying pressure was met with some tepid iceberging.
Acquisitions and POMVUM announced confidential submission of draft registration statement to the SEC and amendment.
We have posted out the Canadian retail sales February reports on the feed for anybody interested.
That's India, Sandy, Romeo, Lima.
So yeah, some moving parts this morning, but nothing too extreme, nothing that really caught the market off guard so far with earnings, with economic data. The next biggest event of the day is really going to be this
LUCY, Innovative Eyewear, announced new patent filings and receipt of notices of allowances on smart safety eyewear. That's Lima Uniforms Charlie Yankee, LUCY.
And if you're trading gas or oil, you've got gasoline stocks and crude stocks. You've got data coming out from EIA at 10:30 a.m. So important to watch that. Overall, positive reaction to that data from the market so far, but nothing too major. Really, just seeing
VTAK, Catheter Precision,
2.5 handles.
announcing.
We have also posted out the US durable goods March prelim report on the feed for anyone interested.
Facility. That is Victor Tango Alpha Kilo, Hotel Charlie Alpha.
NASDAQ has a pretty positive reaction, actually.
There's
seems a little bit stronger.
VTAK getting a pop on that news. Catheter Precision, Victor Tango Alpha Kilo.
Got to have that catheter precision, right? So you have a stronger positive reaction here in the NASDAQ, which is noteworthy. You know, obviously some more bullish animal spirits after Tesla turning things around on their earnings call after a rather abysmal report, but coming in less bad than expected. Remember, we went into yesterday with put skew very elevated on Tesla. Everyone was betting on downside. You didn't get that sort of end of the world type of earnings report, and you got management really trying to talk up the stock. And so I think that led to some short covering, but also, you know, folks trying to hedge into what will be a loss in the value of their puts during the trading day. So let's take a look at how that stock is trading pre-market. Giving just a little bit back, but it had been, I mean, and it really overall has been very excited overnight. Live streamed the conference call and listened to the entire thing. And again, you know, I feel like there was more hype than substance to what was said. I think what the market really keyed in on was management saying, you know, hey, we're going to make these cheaper EVs and we're going to put them out in the first quarter of next year. So that's a promise that you know, folks are really hopeful for. There's a lot of investors whose thesis on Tesla kind of relies on that so they can expand their market share. Tesla also talked about reducing the cost of goods sold by optimizing their production process and using all their spare capacity to build these cheaper cars. You know, so they're really trying to key in on efficiency. I think the market liked hearing that. And unfortunately, headcount reductions, when contextualized properly, also tend to be bullish in terms of how they're received by the market. Whether or not they end up being that way for the company in the long term is another matter altogether.
HPQ and RACE, Ferrari enters into partnership agreement with HP. That's Romeo Alpha Charlie Echo Hotel Papa Quebec.
Nevertheless, Tesla just a little bit off of its highs this morning. Let's check in on silver. Silver giving back some of yesterday's gains. I still do like it above $27. I think that it could potentially continue its run and really catch up to gold. So I'm a little more bullish on the metallic Widowmaker than I am on gold itself. But checking in on gold, just trading around 23.27 pre-market here. And it's kind of just been toying around with this point of control for most of that session. So no real decisiveness so far. Euro seeing just a little bit more strength coming back in after that print, but the dollar is overall up pre-market. And crude oil slipping below that 83 level, which is just about 2 cents above the point of control. I like oil above 80.55. I think also that upward trend line that we have going back to earlier this year is a decent place to rebid this, but I remain constructive on energy, but even more energy companies. I think energy stocks are actually set to outperform oil. So on dips, I favor buying energy stocks, and you know, you can be selective and buy individual companies or you can buy the ETFs themselves, but some of the plays that have really worked well for us so far are things like Liberty, LBRT, Vital, VTLE, Patterson, P10, Exxon Mobil, Chevron, Halliburton, Schlumberger. And then there's also Diamondback or Fang, which operates in oil and gas. And of course, there's the broader ETFs like XLE and XOP, all of which I would rather own versus the commodity itself, but I'm bullish on both. Let's take a look at small caps slipping a little bit here pre-market. Been a pretty choppy session overnight as well. And look, we see SPOOs slipping here. That's the trader nickname for the S&P 500 futures. Just challenging that point of control now. We do see call interest building at 5100 SPX. So that is going to be a level to watch pretty carefully for us because it could provide some degree of resistance.
B. Riley hitting 32.30. 9 at the highs. Romeo, India, Lima, Yankee. Company investigation into B. Riley showed no links to alleged misconduct associated with Brian Kahn, a key client of the company. That's RILY.
Yeah, someone mentioned NQ rallying with the 10-year at 4.644%. It is interesting to see the apparent ambivalence by equities once again towards elevated interest rates. Something to keep an eye on, but I think if we do have further pressure upward in rates, that ambivalence will fade. And that's one of the reasons I think that 5-year and 7-year auction today and tomorrow will be important, as well as GDP and PCE.
after soft Canadian retail sales.
So watching GDP and PCE this week, you know, depending on how they come in versus expectations. Again, this is a market that wants bad news in the sense of slower than expected growth or lower than expected inflation, although the lower than expected inflation would overall be good news, but it wants misses, right? It wants misses versus expectations is basically what I'm saying in terms of this economic data. So softer than expected would be well received, rates down, equities up, and the opposite would be true if these data points came in materially stronger than expected. Rates up, equities down would be the more likely reaction. So I think the macro data matters again for the market in ways that are a bit different. It's more sensitive to it, similar to these treasury auctions. You know, if you have a big tail in the fives, rates up, risk down, and the opposite if it's a well-subscribed auction. We can contextualize things in almost that much of a simplistic manner because that really has been how the market has been reacting. So folks, I don't know if you noticed, but I did upgrade my streaming setup just a little bit, and that enabled me to increase the resolution a bit as well. So hopefully it looks clearer for you all when I'm streaming from my system. So someone asked where I would put my stops on silver, and I'm going to answer that by both talking about it a bit, but also showing a chart. Okay, so just pardon the trading view chart popping on screen here, silver. I would stop out below this uptrend line. If we see price accept below here and it's a moving target, obviously, I don't want to be long it anymore. I do want to see price really stay above 27.045, right, on a closing basis, and so far it has. You can see how it's kind of hugged that level. But I'm still willing to kind of hold my nose and be long silver as long as we don't bust below this trend line, which has been pretty well defended. So that's kind of my view on silver right now, is if we break below this trend line, I think we're right back to like 25, 23, right? But if we're able to kind of honor this area we're at right now and hold above or even bounce off the trend line, I think we're going back to recent highs just below 30. So that's kind of how I'm looking at silver right now. I think that with the way it's trading at the moment, the risk to reward is favoring further upside, and the entry is pretty attractive. But if we slip below the trend line and accept that, I would have no problem fading silver back down to 25, 23 and looking for another opportunity down there. So let me know if that helps in terms of how I would contextualize the silver trade right now. And this is something that is not for the faint of heart to trade. So with silver, small size, wide stops, and patience is required. It's something that can rip faces off. A lot of people get too big in size and it can kill you because it's a very volatile and somewhat at times illiquid metal. There can be slippage when there's big market events happening. So, start real small with silver. That's the other thing I would say. But I like to see how the market is defending this level, this 27.045. This is a level I talked about before we even saw the market really start to defend it. And it's based off of the prior price action, right? Market has muscle memory. And so I identified that level as a key pivot. And I think as long as we stay above it, we can take more bullish intraday trades on silver and look for more bullish swings as long as we stay above the trend line. Yeah, you're absolutely welcome. Great question. Seeing a little bit of selling pressure pre-market here. We've still got about 44 minutes left until the open. But after that data print, initially we had a bit of a positive reaction here. We're seeing that more than reverse. We're now trading below VWAP and the point of control as we approach that market open. Similar look in the NASDAQ as well, below point of control, but just above VWAP, at least for the moment. And Russell really looking worse than the others. Just kind of straight down. Obviously not a huge move, but still small caps not looking so great with rates on the rise. Let's take a look at the 10s. We're just going to zoom out quite a bit here. We can see after the data print, we had 10s slip lower, move higher, and now slip back lower. Interesting move overall. You did see some icebergs selling into the top of that last move, and then the sort of exhaustive stop out in the top of that second move. But overall, it looks like the market is pricing in that durable, saying, okay, this is a little warmer than we expected, not necessarily hot. And so there is just a little bit of de-risking in duration and risk. And we do see liquidity starting to build below us a bit more than above us on S&P. Just showing that there is some demand at lower prices. And we continue to see supply, that is to say sellers are continuing to dominate the tape. The larger the red bubble, the larger the sell delta, or the larger that sales are outweighing purchases in S&P futures contracts. So these delta bubbles give you a sense as to kind of who's winning the tape, not just based on the price action, but the prevalent flow. Someone asks, can I look at CLSK? Yeah, what time frame did you want to look at that? Just pre-market? I can pull it up here on Bookmap. We could also look at a longer chart if you'd like. Just let me know what you'd like to do there. But for now, I'll put it into Bookmap so we can at least see what it's doing pre-market. So it'll pull the historic data. It'll give it a moment there. All right, and then I'll just need to clean up the chart real quick because it's just a little bit busy off the bat. And so here's CLSK from the pre-market session that starts at 4 a.m. Pretty volatile trading vehicle overall pre-market. I know this thing's been up a lot. So, you know, you could see a little bit of settling on that. Let me just take a look at a couple of other areas on this. And we'll zoom out so you can see where some of the resting liquidity is in case that helps. There is a lot above. So there's a lot of offer, a lot of supply above us here. Sorry about that. Just pulling up a longer term chart on my screen. So on the longer term chart, I will say it's interesting. It definitely has, you know, momentum favoring buyers pretty strongly. Can see that in how it's above the point of control. I'll just pop this on screen so you folks can see what I'm talking about. So here's a chart from TradingView. You can see how we are above this point of control here. This is the largest area in the volume profile, so it's a pretty decisive area. There's a lot of supply there, and buyers chewed right through it. Okay, so that tells you they've more than taken control of price action. It's also above the cloud. You can even see that nice little touch. First it was resistance, now it's become support. This is a volume-weighted Ichimoku cloud. So that's also giving you a sense that now a lot of those buyers are in the money. So they're kind of also in control of price action. You know, I'd go so far as to say it looks like it's starting to form a
Trade
pretty
CLSK at DX feed sell price 20.53. Size
healthy base there,
3497.0.
just around this trend line. So this would be an area to watch as well, this trend line for potential support moving forward. But so far, looks like you know, buyers have pretty decent control of this stock, and it could push a bit higher, and then you're going to get into another area of supply up here, just around 23-24. So hopefully that helps. And you can see that, look at that up here, these resting offers matching up with those supply areas we see in the volume profile. So where people previously transacted matches up where they want to transact, if that makes sense. That muscle memory of the market. And if there's any charts folks want me to look at, let me know. Happy to do it. Happy to check out whatever is on your minds here as we approach the trading day. We're going to switch back here to the S&P 500 futures as we get ready for the market open in just about 37 minutes. Yeah, you're welcome. Sure. Are there any in particular that that you would like me to
Kazakhstan's energy
look
ministry
at?
comments
Okay,
on
Netflix.
output plan for OPEC Plus. It prepares a plan for compensating excessive oil output.
So let's just take a quick look at Netflix here. I'm just going to add a new spot for it. And we're just going to pull it back
Also seeing
to...
reports that Israel is moving ahead with operations to target Hamas in Rafah, according to a government spokesperson.
Pull it back to pre-market and everything. So we'll look at Netflix short term, then we'll zoom out and look at it on a longer time frame. So first, here's all your pre-market action in Netflix. Just gingerly moving it out there. There we go. It's a bit of a drop from earlier this morning, it looks like. And we do have a pretty solid area of bid right below us here, just about what, 50, 72, 50? There's about 1,000 on the bid. So it'd be interesting to see how price reacts to that level. Right now, it's trading down about 0.75% pre-market. And this is a stock where they delivered excellent earnings, very impressive subscriber growth, but their outlook was not well received by the market. They're basically saying, okay, this is a peak for a little while. They also said next year, they're no longer going to be telling us what their subscriber numbers are, which is a little weird, honestly. So Wall Street will have to make inferences based on their revenue and otherwise. So let's bring up Netflix on screen on a larger chart. Okay, so here we have that on screen. We're just going to kind of zoom that back just a little bit. Let's see what we can see here. Not much of a healthy trend line here. Looks like it kind of broke below on that earnings gap down, right? So just kind of back of the napkin lines here, so don't hold me to it. But this is telling me right now that Netflix is trendless, okay? So when you're inside the Ichimoku cloud, that's kind of giving you a sense that we don't have a defined trend. We're sort of in the ether right now. We also have this larger gap in the chart that may get filled if weakness continues. This is a gap that you can see in the volume profile. So it's what is often called a decision zone, right? And you can see we tapped that like almost just right on the nose. We tapped the top of that decision zone, and then there was a rebid back into the cloud. So the market didn't want to move lower at that point. However, if we do start to see that move lower, if we do actually break down below this 530 and change level, let's call it 537, there's a good chance we could get to 500. On the other side of that, you know, if we're able to push back up through the cloud, there's no reason we can't start building up around 608. So I think this one is sort of telling us it needs some more time to settle in terms of which way things go. Right, but I would say there's a lot of risk below this this 537 level that you could get to 500 pretty quickly, just because there's a gap. The market doesn't like to transact there. The last time we had a kind of move just into that lower volume area, it was bid well, so that's bullish in the short term. We also saw that continuation yesterday. So let's see how this thing plays out. I would say Netflix is one where we need some time to kind of see how this settles out. Usually after a move like this after earnings, it needs at least 3 trading days to give you a better sense as to where it's going to base. So maybe we're starting to build that base here. We're certainly above a large volume node, which is helpful. It's giving the buyers a little bit more of an advantage, but to feel more confident about this one, I'd like to see it trading above the Ichimoku cloud. So let me know if that helps you. So we're going to get back into some of these other markets. Look, silver's popped up. It's actually had a nice little bid from earlier. I was telling folks, you know, I still favor buying silver above 27.045. And this has been another day where you kind of got just above that level and saw a 1% rebid in silver. So still bullish of precious metals, still, looking at silver as an area where I think this reflexive rebid can continue. It is an area that is overall under allocated. We do see increasing industrial demand and investor demand, and it has some room to catch up to gold. If you haven't been trading these markets for a while, it's important to go back in time and look at gold in 2011 trading at 1900 and change and silver trading at $48. Obviously, one of the two metals met and then exceeded its 2011 high, and that wasn't silver. So silver, in my opinion, still has room to catch up. And some of the better run silver miners could also be opportunities like SVM and PAAS. So these are areas to watch. Precious metals are kind of giving us a sense of concern about geopolitics, about a
The
Fed
effective
policy
Fed
mistake,
fund rate is
and
unchanged at
inflation
5.33%.
accelerating. So those are areas that I think that, still present opportunities. It goes with this other theme, this reacceleration of inflation theme I've been talking about since the beginning of this year as being an investable theme. Just because inflation's coming back and it might be bad for some parts of the market doesn't mean it's all doom and gloom. In fact, quite the opposite. There's been huge opportunities in energy, industrials, materials, metals and mining. And because of elevated geopolitical tensions, the defense sector has been a great place to invest. And also because of the flight to safety trade and the increasing power requirements as time goes on, utilities have been an area of interest. So no matter what the market's doing, even if your favorite stock isn't doing well, even if the areas of the market that you're used to aren't doing well, there are opportunities out there. There is a rotation underway seemingly into some of these older economy spaces that have shown relative strength versus the broader market.
So Israeli military are poised to launch a Rafah operation immediately, awaiting government's approval, defense officials telling the newswires.
So that's another escalation of geopolitical risk, by the way. Israel venturing into Rafah and the casualties that'll involve and the potential escalation of tensions with other countries in the Middle East that could create. So that might be another reason we're getting a bit of a rebid in some of these areas. Let's take a look at crude here. Crude back up above 83. We talked about it earlier. It was just trading below it. So we'll be watching this one as well. Pre-market, it's just about flat. You are seeing some weakness in the 30-year note and the 10-year note. Pre-market rates are starting to move higher again. Let's move back over to the NASDAQ. NASDAQ's continuing to show some pressure here pre-market. Again, we had that pop after durables, and from then the path of least resistance has remained lower, and sellers are showing some conviction here. You can see that aggression in the size of these selling delta bubbles. Okay, so that is important. And I think that, we're really going to see some interesting price discovery as we get into the trading day. I don't know that this sort of corrective impulse is necessarily behind us in the broader market, and getting news that, the situation in Israel is still kind of boiling is probably not the best news to get into the trading day. But the other issue that I think is somewhat concerning is this inflationary pressure, this resumption of inflation rearing its ugly head in a number of areas is still something to be concerned about. We got PMI data out, and one of the things that it continues to show is prices paid by producers, whether in goods or services, are still on the rise. And that eventually often gets translated to higher prices for consumers, which shows up in inflation data. Let's take a look at the S&P here. Little bit more resilient than the NASDAQ, but, still overall distributive pressure, particularly after we had that post-durables pop. Sort of microstructure downtrend here you can see of lower highs and lower lows. So coming up later this morning, we do get EIA data on distillate, gasoline, heating oil, and refinery crude stocks at 10:30 a.m. That could be somewhat of a mover for the energy markets. We've got the 2-year FRN auction at 11:30, probably not going to be too big of a deal, but the 5-year auction at 1 p.m. I do believe will be quite important. And really for those auctions, the metrics to look at are the bid to cover, the indirect take, and the high yield before the auction and during the auction. The pre-auction yield, if it's higher than the auction high yield, that's a good sign. That's showing you there's decent demand. If the auction high yield is higher than the pre-auction yield, that's the sign of a tail and of poor demand. And that's generally not well received by the rates market. So you can kind of just get a sense as to how well the Treasury auction was doing by looking at those 3 metrics. Just going to look around a little bit here. Silver starting to just consolidate some of those gains, but again, up over 1% from when we started talking about it being a buy opportunity again. This is the second day in the row we've caught that sort of 27.05, 04 low and been able to take advantage of it. And I think that
So just keep
it's
in mind in
an
10 minutes time now
opportunity
at
in the
9:15 a.m. Eastern Time,
precious metal over a
ECB's
longer
McCall
period of
takes
time
part
as
in a
well. I mean, I think there's room for it to catch up to gold, which would suggest that it still has a fair amount of upside built in my opinion. Let's take a look at Tesla pre-market here, see if any of that hopium is fading. Nope, quite the opposite, getting a bit of a bid. But overall, we have seen distribution pre-market. I would be very interested to see how this thing trades today and how seriously the broader investment community takes some of the things said during that conference call. Because again, it felt a lot more like, trying to earn that $56 billion pay package than, a lot of accurate and objective company guidance about what to expect in the near or intermediate term future. Maybe I'm just too cynical, but that's what I got from it. And, just checking it against a bunch of different benchmark points, like what can you do with distributed compute in cars, or how quickly can you spin up an Airbnb, or when will licensing of FSD happen to the broader automaking industry, if at all? Is there that demand? These are all questions that remain unanswered, but seem to be well received. I think what the market is really keying in on, though, is this idea of the cheaper EV models, the lower cost of goods sold, and the idea that they can use spare production capacity to start to build that in by Q1 2025. So we'll see. We were also promised robo-taxis by August. All right, let's take a look at some other charts here as we prepare for the market open. So this is a chart of S&P futures levels that I've been watching. We'll zoom in just a little bit so it's a little bit more helpful in terms of the view. And we can see that these have been areas of price action to keep an eye on. And these are just the idea behind how I'm drawing these is, again, the market has muscle memory. So areas where there has been interest in price can be areas where we see interest in price once again. Yesterday, when I did my stream, I talked about this 5102 level being a pretty important level to watch. It also was an area of, resistance, and we did see that as an interplay, but we were able to push higher. We were able to push another 10 handles higher into the close above another area of potential resistance around 5103. And I do think that, the path of least resistance today is likely to be lower for this market. I think we had this sort of a bit of a reversal of some of the extremes that we had seen. We didn't get exhaustively oversold, but we saw oversold conditions by some metrics. We've more than reset that. And, so the onus of proof at this point is going to be on the buyers to show that they can continue to push this market higher, in my opinion. And earnings are going to be pretty important, as are these treasury auctions and economic data points. So we're just about 20 minutes away from the open. S&P cash implied to
5 minutes
open
time
up
at 9:15 a.m. Eastern time. Then we get
0.07%
comments from
higher.
ECB's McCall, who gives a plenary session and delivers concluding remarks at a high-level seminar on governance and risk culture titled Going Forward by Looking Back, which is jointly organized by the ECB and the Florence School of Business.
So I'm going to give an answer here that is probably not going to be liked, but I was asked any good books to start investing in crypto. Great question. But my issue would be that in order to invest in something, we need to understand how it's valued, and it needs to have a discernible value that's based on metrics that are widely agreed on. The issue with crypto is that there are no metrics. It's basically just sort of priced on greater fool theory. Like, what is someone else willing to buy this from me for? Not what is its free cash flow or its earnings per share or, its EV EBITDA or any of this kind of stuff. There's no valuation metrics for crypto. So the problem is that, to understand what it may be worth is more psychological. What is someone else willing to pay for it at any given moment? And that has more to do with risk appetites and availability of excess liquidity than it does to any kind of discernible, repeatable, widely agreed upon metrics for valuation. So when we invest, we need to have some way to value something. If I'm investing in real estate, there's a way to value that. If I'm investing in equity, whether public or private, there's a way to value that. If I'm investing in debt, there's a way to value that and understand what kind of risks I'm taking and what kind of upside I can expect. I can't do that in crypto. There's no real method or technique to be able to understand like what a Bitcoin is actually worth that is widely agreed upon. So I would say that the issue would be, if we're investing in crypto and we're investing in crypto itself and not some of the peripheral industries like the miners where there are businesses that you might be able to discern a value from, it becomes a little bit more challenging, right? So I would say it's not as much an investment as it is a speculative relief valve for excess liquidity. And there is excess liquidity. You've had this very strong fiscal dominance last year and going into this year. That amount of deficit spend and supportive fiscal policy has created an abundance of money, and it's looking wherever it can to find returns. And one of those places has been crypto. The other thing is, the US has been using the dollar as a weapon. And the more it does that, the more countries around the world start to look at other options, including gold and potentially crypto for people to transact in away from dollars. And then, of course, you've also got the situation in China where there's very aggressive capital controls, but there's a lot of people that also want to move their money out of the country. So they're using crypto for that purpose and also sort of diversifying away from gold and real estate as their only holdings. So I would say that, it's an interesting area to speculate, but in terms of, really getting a good sense as to how to invest in this space, I think the folks that make money consistently are the ones that are able to produce something, you know. So for a while, that might have been some of the better run miners, although I think a lot of them are negative free cash flow, if not all of them. But in terms of crypto itself, it's much more like, you know, what kind of environment are we in? How much liquidity is out there? What kind of appetite is there for the unlimited speculative risk of this stuff? Because like if I buy a company and I'm buying it, let's say I'm doing a value buy and I'm buying it below book value. If I'm buying that company and I see it getting broken up or getting taken into bankruptcy or whatever, I know that the value I bought it for is less than what it's worth if it's broken up or sold or whatever. So I see upside, right? I can't do that with a Bitcoin. I can't look at a Bitcoin and say, okay, here's its intrinsic value. Here's its, you know, what I could liquidate it for no matter what, right? And so that's kind of a bit of a concern. You have those same kind of metrics for real estate. You kind of have your worst case scenario. What could I liquidate this property for? There's always going to be some value, right? And this is elusive for gold too, by the way. It's not so much for silver because it has industrial capacities that are pretty significant in terms of why it's used, but gold is another vehicle where it's more difficult to discern what its value is because there isn't really a universally agreed upon way to measure supply and demand versus what fair value for spot should be. So I think between gold and crypto and other kind of assets that might be numismatic or collectible or otherwise, it can be more difficult to discern what a fair value is, and therefore it's harder to call it an investment. It's easier to call it like a trade or a speculation vehicle. So I know that may not have been exactly what you were hoping to hear, but I'd be remiss if I wasn't honest about my view here. So hopefully it at least is helpful. All right, I've been asked about another stock. I think that one is Humana. Let's take a look here. Yeah, okay. So we're going to take a look at Humana. This was a request that came through in one of the chats. All right, so we've got Humana on screen here. We'll zoom out just a little bit to get some better context as to what's going on in this chart. So we'll go to a weekly chart. Boy, that's been a bit nasty, hasn't it? It seems like it's made new multi-year lows. I'm going to take this back just to see how far back we have to go to see these lows. So really, we have to go back to like the COVID crash to see Humana trading at these levels. So that's interesting. I would say that you know, you may see some near-term support not too far below where we're trading right now. But I'd be pretty careful with this one because the momentum is very strong to the downside. I mean, it's just been slipping and slipping and slipping. You know, comparatively speaking, you haven't seen a lot of transactional activity at these elevated levels versus what you see below. So if we do slip below those COVID lows, you can get kind of drawn back into this larger area of the multi-year volume profile. So I'd be a little bit concerned about that just over the longer time frames. So let me pull in a shorter time frame chart of Humana here. We're just going to close out Netflix and replace it. Imagine a lot of investors are saying hum right now as well, with this thing just not performing very well, comparatively speaking. So here's Humana on the data feed. Let me just clean this chart up a little bit. Then doesn't seem like it's a stock that trades much pre-market, so we may not get much from this until the trading day really starts. Just as a heads up. Because you can see there hasn't been any transactions here for like 10 minutes. So let's see if we can pull it back a bit here. Yeah, this one really is not much of a pre-market trader, so we'll have to look at it after the market starts trading. You do see, you know, some resting liquidity here below, but I'm imagining that in about 12 minutes it'll look quite a bit different. But hopefully at least the zoom out helped in terms of where we are. We're back to these COVID low levels. And there's a lot more resting or I'm sorry, there's a lot more transacting that happened well below these levels. So if we don't keep them, we can get pulled quite a bit lower, a bit like a magnet. You can also see on that, again, going back to that multi-month chart, on that chart, it's struggling to stay in that cloud to say that it's not going into this sort of multi-year downtrend. But on any other time frame, you can see that it's thoroughly in that downtrend. The cloud also flipped red. And when that volume weighted Ichimoku cloud flips red, that's also just giving you a sign of danger, like further downtrending is quite likely here. And the stock slipped and even gapped below its point of control that goes back about 6 months. So all of it gives it kind of a bearish view overall. It really needs to catch some strong support down here between 291 and 285. So hopefully that helps. Someone asked about Snapchat and whether it's primed for a big move higher. Let's just pull up Snapchat on the feed here, and I'll look at some other areas as well for the stock. Just give it a moment to populate, and then I'll clean up the chart real quick here. Just get rid of some of these unnecessary labels. I like things clean and simple wherever we can get them to be like that. So Snapchat, since pre-market trading started, has just been selling down. Pre-market implied gain is just 0.5%. So not too much to see there that's particularly encouraging right now. Let's look at some of the options levels on this one. Yeah, I'm not seeing a whole lot on Snapchat that gets me too excited near term. Let's look at it just on a longer term chart here. So I look at this one, and that gap down is so nasty. Maybe at some point that gets filled to the upside, but I look at this one as it's pretty clearly in a consolidation range. It's been consolidating that massive fall it had from its prior earnings, and it seems like Snapchat just loves to do that, loves to have these massive gap downs on earnings. The one thing that you can hang your hat on is it's above the point of control, right? So that's just above $11 here. That's helpful. That's where the vast majority of transacting in the stock has occurred in the time frame on screen. You can see that in the consolidation. Lots of transacting in that range. But we're also below the volume weighted cloud. And look, every attempt to get back into it to neutralize that overall longer term downtrend has been met with selling. So it's hard to say that I'm too bullish on Snapchat given the look of this chart. Let's zoom out just a little bit more too. Oof. Yeah, so this just looks like a long-term complicated bottom with a lot of like fake, like head fakes, right? These sort of head fake ramps that get sold into, the last one being the most profound we've seen in a while. I would still be pretty careful with this one, particularly with earnings coming up. Earnings are coming up tomorrow after hours on Snapchat. So if you have a stock or a futures contract or something else you'd like me to look at on screen, let me know. We can look at it in multiple different time frames and get a sense as to what it looks like, what the probabilities are overall. We're just about 7 minutes out from the market open. We did have durables earlier. They came in just a little bit stronger than expected at the headline level at 2.6 versus a consensus of 2.5%. The reaction to that was initially a pop, but then we saw selling pressure from there, and the S&P right now is implied to open higher by about 0.14%. Yeah, you're welcome. Been asked to look at Disney, so I'll bring that one up. First, we'll start with a longer term chart. So Disney's had a pretty nice recovery overall. I think that sentiment got just a little bit blown out of proportion on the negative side for this one, so that probably helped a bit. It does seem like it's in this longer term structural uptrend that started late last year. And you can kind of just look at a chart and even without drawing any lines or having any indicators or anything, you can look for one very simple thing, and that is higher lows and higher highs, right? So you see that kind of a pattern with this chart. I like that overall. One thing that I would say, you want to watch out for is just the way this thing has a big gap here. That is a risk if you close below that level where you gapped up to, you could get back down. So one of the downside risks as we get into earnings season is just sort of refilling that gap to the downside if you close below it. You do have that support from the trend line and potentially inside the cloud as well. So it wouldn't just be a straight drop, probably be pretty complicated and you'd have a bunch of chances to avoid that outcome. But you can see that's an area where there's nothing in the volume profile. So it's what we like to look at as a bit of a decision zone, right? And you see the last time the stock creeped into that area, it was quickly rebid even before the close. So you kind of got to ask, how is price reacting when you tempt those lower levels? Do you get a really quick kind of rebid so it's a head fake look below? That's fine. But if you get something, where you continue lower, where you close below that level, that's where you have to be a little bit more concerned about downside potential. But on the other side of it, I think, overall, this thing looks like it's put in a long-term reversal. It looks like the path of least resistance is higher from here. And I think it's going to have a lot to do with its earnings and particularly what's going on at the parks. We know streaming has been an area where they've kind of struggled to really make money at the bottom line and have the kind of subscriber growth numbers we're seeing at Netflix and elsewhere. But on the other side of it, parks are their big money maker. So it's really going to be about that continuing. They also are able to have some degree of pricing power there. Obviously, you can't have a Disney park experience at a non-Disney park. So they continue to raise prices and people continue to buy. So I'd say overall, I like the look of this chart, particularly on the long term. I think it gives us a sense that it's taking a breather here. Perhaps we get back to this trend line in this lower area where the gap starts and we get a rebid. That would be an area I wouldn't mind entering Disney, particularly if we get the earnings risk behind us. But, because it's earnings season, I don't necessarily want to be too aggressive taking positions ahead of earnings. Because it tends to be a bit of a kind of like a binary outcome, right? Unless you know something in advance, May 7th is going to be a pretty important date for Disney, right? So you've just got a little like basically 2 weeks until you have that event. So I would be careful about that in terms of the risk to either direction of this trade. We're also trading in an area that is likely to be a bit of resistance. You can see this as being a supply zone. That's the last time the stock got sold down aggressively. You had this look below, and you had this look below and they were well bid. Well, the look above this level was sold. So on the other side of it, you see that here as well. 2 look above sold into. So you probably can expect that 120-192 level is going to be a pretty important proving ground for the bulls. So hopefully that helps with Disney. Yeah, you're welcome. So we're just about a minute out from the open here. We see a little bit of a rebid off those pre-market lows in the S&P. Small amount of institutional accumulation, but some selling as well. It's just sort of been pinging and ponging in terms of the institutional participation in the S&P futures. NASDAQ having a nice rebid as well off of those lows. Both of these climbing up above their point of control. Well, I should correct myself. NASDAQ climbing up above its point of control in VWAP. S&P struggling with its VWAP right now and trying to get above the point of control. Russell, let's look at this one. It's been one of the weaker of the three. Also showing a somewhat similar look here, though. And there's this high conviction buy down here. You can see that in the size of that delta bubble. And it's just been higher from there. So it's also important to get a sense as to where sellers are being absorbed. That's some absorption right there. You can see it in the chart. Let's move back to the S&P as we get into the cash open here.
Large trade in TSLA at DX feed stock by buy in 1,395,950 shares.
Well, someone's excited to buy some Tesla there.
Large trade in TSLA at DX feed stock by sell in 17,239 shares.
Let's just take a look. Yeah, Tesla actually seeing a bid to start the day. So there is some further excitement in this stock. And we can see that resting liquidity stacking above us and below us here, providing some points to watch in terms of where demand may begin to dry up. One thing I'm going to do, however, is I am going to disable that alert because it was configured for after market volume. And we don't really need that during the trading day as much. And we'll just zoom that chart in so when we revisit it, it won't be quite as stretched out. You can see the euro getting a nice little bid here as well. That tends to produce some supportive intermarket dynamics for US stocks. So I've been asked about New York Community Bank. I will say I don't have a strong fundamental view on this one because it's not really a stock I've been following, but I can at least look at the technicals. And they look kind of horrifying, if I'm being honest. We have to go back quite a ways to find price coming down quite to this level. Perhaps this is an area of support where it last based. You can see that kind of corresponds to where it was, oh, you know, all the way back in like 1999, 2000, 2001. Current price seems like it's basing just a little bit closer to the great financial crisis lows. This thing looks abysmal. I mean, could it get a pop? For sure. Anything that's sold down this much can certainly get a pop. Would I hang my hat on that as being the most likely outcome? I don't know. It looks deeply troubled. It looks like there's motivated institutional distribution of this thing. So, you know, can it move all over the map? For sure. Are we going to have a real technical edge as to where it goes based on this chart? Not too much. I mean, I would say that you need to chew through some of this overhead supply and probably get above 383 to have a chance to start to move some more. And then you've got this other area of supply. It starts around 450. So you've got, you know, a fair amount of people that if price resumes anything even vaguely resembling positivity, they're likely to be motivated sellers because they're probably caught in this thing at higher prices. So if they're able to get out with a smaller loss or break even, I think they'd be willing to do that. And I think that's what makes this overhead supply currently a bit daunting for the stock. And, you know, the area that it's in right now, it can get trapped in, and it has been overall trapped in, other than that look below that was rebid. It has been overall trapped in that area. It has been an area where it seems to, where participants seem to like to transact in the stock for right now. So I'd say that's a bit of a magnet unless you're able to really push above that supply at first at 383 and 451. But overall, for me, I just wouldn't touch it because I see it as a high risk stock. There's not really a clear picture as to where things go from here other than it being a troubled bank. And I also wouldn't necessarily want to short it because of how much it's already fallen and how, you know, you could have an event that takes this thing down or up 50% at any given moment, just given how troubled it is and how less, participation has dropped in this thing significantly as well over time, right? So you have less and less people wanting to transact in it other than to take their losses and move on. So I think that's another bit of a concern with New York Community Bank. So for me, this would be on my no-touch list. In terms of stocks to trade, I wouldn't be particularly interested in wanting to take a position in it one way or the other. I wish everyone the best of luck that's trading it. You might be able to make some money, but it's also below $5, which means that a lot of brokers, it's going to be one that consumes 100% of buying power per dollar. And that also makes it less attractive to me if I'm wanting to play around with swing trading it. So the average volume in this thing used to be 42 million. I know that's obviously during a period where volume was elevated, but yesterday's volume was pretty low, comparatively speaking. So I would just be a little bit more careful on this one. Yeah, absolutely. And the whole space of regionals and community banks, there's pockets of strength, there's pockets of weakness. You got to kind of get a sense as to what these things own, what they're exposed to, what their risks are. The biggest area of risk for these things is really their exposure to office building debt in troubled regions. And that's not a story for every regional or every community bank, right? There's just these pockets of weakness. So I know some folks have said, and it's a bit of a shift of topic, but some folks have said we're going to have this sort of regional bank apocalypse, commercial real estate apocalypse, all that sort of hype. I don't subscribe to any of that. That's completely blown out of proportion. All right, so we've got a couple of other questions here. Is TLT a good FOMC strategy? So I'm not so sure if you're talking about TLT as a long or a short, or how you're talking about playing it like a vol straddle or whatever. But I would just contextualize Fed policy a little bit more carefully. So the biggest impact that the Fed has on the rates market is on the shorter end, right? So it's mostly going to be in the bills and the shorter duration notes. When you go all the way out to the long duration bonds, you're taking risk based on a different set of views, and it's largely driven by the combination of the economy and inflation expectations. Now, if the Fed announces something pertaining to a change in how they're going to do quantitative tightening, like a taper, that could certainly be beneficial to TLT. It's also at the mercy of Treasury and how they plan to raise debt. If you see more issuance on the longer end, that can push rates higher. I would say that for the Fed, I'm not so sure I would want to be playing TLT because it doesn't necessarily respond to the baseline of what the Fed is going to do as much as, say, the 2-year note. So maybe that would be an area that would be more interesting, although SHY doesn't really move that much. The shorter end of the yield curve doesn't have as much beta. But on the longer end, the reason that I'm a little leery of TLT is there's no term premium. Like, you're getting paid better to take 30 days of duration exposure to U.S. Treasury debt than 30 years. And yet there's much more uncertainty about dollar purchasing power and inflation and the government deficit spend and all that over that 30-year period than 30 days. So typically you have what's called a term premium, where you're paid more to take long end risk than short end. And because TLT is something where you're basically getting return-free risk, right? Like, you're not buying a 30-year bond where if you hold it for 30 years, you get 100 cents on the dollar. You're buying something that very much keys off the price of the 20 and 30-year bond. So you're taking risk to your principal, and the goal is capital appreciation and maybe a dividend, but you're taking that risk where there's no term premium and where inflation's reaccelerating. So for me, I would be careful about TLT. I don't see a strong reason to want to buy it. I'll show you what I'm kind of looking at in that space. Like, short term, you can certainly get pops, but I feel like long term, the path of least resistance is lower. So this is ZB. This is the 30-year bond contract. And you can see what it's telling you here, right? It's kind of a clear pattern of lower highs and lower lows. Like, so you get this lower high, you get a lower low, you get a lower high, you get a lower low, you get a lower high. So in all likelihood, if this pattern continues, you probably get a lower low, right? It's just sort of mechanical distribution. So short term, sure, you can get pops, but on this weekly chart, we're below the point of control, we're below the Ichimoku volume weighted cloud. Everything says it's still a downtrend, even just the most cursory analysis that we just did. So I'd be careful of it personally. That's just my own 2 cents. Let's take a look at Exxon. That's another one that was requested. And as you all know, I've been bullish of oil and gas for quite a while. Really, since the start of this year, I started getting very bullish of this space. And my partner, Aisha, recommended Exxon stock, I want to say in Feb. It's been an absolutely fantastic run. It's up 20%. And I think that it's consolidating. It's showing some great relative strength versus the price of crude, by the way, which is quite encouraging. I think it still has room to run. I am a buyer of dips in the energy space. So for all of these energy stocks that are higher quality, Exxon among them, I'm interested in buying into weakness as long as it kind of remains, in a positive trend. And it's in a pretty positive, strong uptrend right now. So I'd say as long as it kind of remains in that structure, and as long as oil is staying above, let's call it 75 or so, I'm still bullish of Exxon. Exxon has still got a lot of opportunities at these higher oil prices. If their Permian Basin operations are pulling oil out of the ground at $30, $35 a barrel, obviously there's higher costs once you factor in refining and everything else. But this is a company that has strong margins, that has a rock solid balance sheet, that can execute really well in this environment, and even buy some smaller players to improve their production over time, and also to expand, vertically as well. So I would overall continue to look at Exxon and Chevron, the kind of leadership plays in the space, bullishly. I'm still bullish of Halliburton and Schlumberger. I also like some of the smaller players like Liberty and Vital Energy. These are all plays that we shared on MacroVisor earlier in this year before this big appreciation happened, but we're still thinking there are opportunities to buy dips in energy. Energy is still attractively priced as a space. So when oil starts to roll over and people start to dump their energy shares, when we see hedge funds continuing to dump their energy shares and even short the space, that all makes me bullish, as does the relative underperformance of energy versus crude. And I think energy as a space, as a sector, has room to catch up higher. So for Exxon, I think it does have room to run, but it's consolidating. And we're going to need to see oil continue to push higher for this one to catch a stronger bid. I'm still constructive on oil overall. If we look at crude real quick, I can kind of show you what my thought process is on this. So this level down here on 80.56, this is a pretty key area that we need to see price rebid for short-term bullishness, or at the very least hold this upward trending line on the bottom, right? As long as we're in this pathway, I'm pretty constructive on crude. And obviously we have this point of control as sort of like the last resort. So maybe not 75, but 78 being an important level. But overall, we can see crude has been well behaved. It's still in this uptrend channel. It's seen a bit of a reset as geopolitical tensions simmer. They are on the rise again, and we are still in a supply-constrained world for oil where demand seems to be picking up. So I still favor being long energy and accumulating on dips. So hopefully that's helpful. So that rebid in S&P is continuing. After the open here, we had that little bit of a dip, maybe some continuing pressure from yesterday's close where we sold into the close, but now we're seeing that bid growing, and we see resting liquidity building above us as well. And this area around 51.35, that is a key area. It corresponds with our gamma flip level. It also corresponds with an intermediate term wall of calls, and is just above the fifth largest level of gamma positioning, which also aligns with the level of resting liquidity. This is one reason that advanced SPX options visualizer can be pretty valuable if you're trading S&P futures. This is something that I built for Bookmap that's in their marketplace as an add-on. And it works for both Rhythmic and DX feed data. So I was asked about C Limited. This was one of the stocks that I was talking about as a buy opportunity in February. It ran from about $40 to 60 and change, and now it's starting to move again on upgrades and really just this idea of emerging markets starting to get back into an early credit cycle environment that, you know, should see more demand for goods, should see more demand for services, and should help companies like C Limited. So let's take a look at this stock on screen. Just give me a moment here. So overall, it's starting to break out of this range that it was in. So, you know, just at first glance, I do like seeing that. I think that's constructive. We'll be looking for a horizontal on that just to kind of drive that home. So breaking out of that range, I like that. I like that we've seen it kind of base as well, right? We had this really long-term basing period. I like to look at this as sort of like a spring coiling up. And when it does eventually move, it tends to move big, as did this stock. It moved about 50% off of that low in the basing. We saw another basing recently, and now we're starting to break out of it. Now, albeit it's a smaller time frame of basing, so perhaps the move higher won't be quite as powerful. But I would be constructive on C Limited here. I think it does have more room to the upside based on what we're seeing. And I think my initial look on this thing, you know, would probably take us to around 69.86 as a near-term upside target, where we could start to see some supply concerns again in terms of where other folks that were in this thing at higher prices could want to start to exit. But from there, I don't see any reason why we couldn't make a more determined push higher. So we are above the cloud on the weekly. We're breaking back into an uptrend. We do see this, you know, breaking out of this near-term consolidation range. So I think it's probably got another, you know, $5.50 of upside in the near term. And as a longer-term investment, it's certainly one worth keeping on our radar. We can remember that, you know, over the very long term, this is still a basing pattern, right? Zoom out for greater clarity, and you can see this pattern that we're in right now is actually very constructive. It's this sort of constructive longer term reversal. So this is one to keep on your radar. I think it does have room to keep moving higher. And I'd be looking at that 87 and 31 cent level as a really decisive level. If we can break above that, maybe we can start retracing some of those prior gains. Do we get back to the COVID highs? I don't know. There's a lot of folks that are probably going to sell along the way to that journey. But I do think that this is a company that has been beaten up too much. The market is starting to scoop it up. It's almost doubled from its all-time lows, and it likely has room higher from here. All right, let's take a look at one more stock here, and that's going to be HA. This was requested by someone on the YouTube stream. That's Hawaiian Holdings. It does look like a pretty well-defined downtrend on a monthly chart here. So let's just zoom in. We'll get a little closer here. Had this big gap up on the weekly chart. That is interesting. Often is the case, these gaps get filled, especially if we start to break lower, and we are. We can see this gap started around here, we're breaking lower into that range. So there is some chance that gap could be filled to the downside. If it was, it would put, $5.05 on screen. So I think it's interesting that we've been rejected at the point of control. We tried to build some acceptance above there. It didn't hold. We're seeing this thing starting to sell down again. Now, I can't say I'm familiar with the fundamental picture of this company, so I'm not going to speak to it from that point of view. Just on a technical basis alone, it does look like it is weakening. And I would be very cautious wanting to go long this thing. I do agree with, your point of view of fading it. Everything kind of tells me this thing has room lower. Now, is it going to get all the way back to that gap fill level of 505? That's a bigger question. We can always have a head fake look below like we had here and get pulled back above. So I'd be very careful about that if you're shorting this thing, but I would not see any reason to want to go long. So yeah, path of least resistance on HA definitely seems quite a bit lower. And so just a continuation of that theme from earlier, markets kind of building on those earlier gains. You do see liquidity building above us as well, which tends to be pretty bullish as long as it's not an overwhelming amount of liquidity, that sort of death cloud phenomenon we talked about and we've seen act as a area where the market can reverse. We're not seeing that yet. We do see liquidity building above, but it's nothing alarming. It's overall pretty constructive. And you do see that most active call strike in the advanced SPX options visualizer corresponding with the largest level of a resting offer above us. That is not a coincidence. The options market has a big impact on how market makers are hedging and how institutions are placing these orders. So I would look at that as a convergence level that's very important, that 5135 on ES. And when we look at the unusual sweeps coming across the options market, we've got Carrier 5750s for May 17th coming across. We have Northrop Grumman 500s for June 21st. These two trading over 100,000 in premium demand. Tesla 162s for this Friday, 200,000 in premium there. Celsius Holdings 80s for May 17th, 100,000 in premium. More unusual sweeps on the individual and ETF options side, individual stock and ETF options side, than we see unusual demand for puts. So that tends to be relatively constructive. And for folks that are reluctantly bullish on natural gas, some good long-term news from Baker Hughes, seeing 20% natural gas demand growth through 2040. Right now, storage levels are still above their 5-year max range. So, that's one reason natural gas has been kind of volatile and reluctant to hold too much of its gains, but we are starting to see a bit of a recovery. April tends to be a bullish month for natural gas, on average up 75% of the time, with a gain of 4% by the close of the month. Let's take a look at the NASDAQ here. NASDAQ rolling over a little bit. This resting offer above it at 17,800, scaring buyers away, really not showing that they had the demand to take us through that price. So now we're seeing a bit of a reversal, down about 50 points from that level. Also see some upward pressure in 10-year note rates with the price
Block
of the
trade
10-year
in ticker,
falling.
BEN.
So that could put a little negative pressure on equities. Russell, kind of ambivalent so far. Pretty interesting to see that versus what we're seeing in the NASDAQ. NASDAQ, let's see, it's now testing the VWAP here. Earlier, with all the demand that buyers put in, they were able to pull this point of control higher. So we're testing that convergence of the point of control and VWAP on NASDAQ and starting to push a bit lower here. Let's check back on the S&P. S&P has a bit of a
Yes,
similar
stop
look here.
alert. Sell 1165.
Ooh, and
Stop
that's
ESM for CME sell at 5,111.6 volume 750.
yeah, you're definitely seeing some stop outs happening there in ES as well. These are sell side stops getting blown out to the downside. Let's just zoom out and see what the picture for liquidity looks like. You do see liquidity building below in ES here. With about 225 contracts at the 5,100 level coming in. That was a little larger earlier, however, about 286. Let's take a look at what's going on in crude. Just trading below 83 again. Silver giving up a little bit of its earlier gains, trading at 27.26. And gold holding the line above 2,300 so far. Let's take a look at Tesla here. This one's kind of all over the map today. You can see it had that real strong open, then it gave a bunch of that back. Now it's coming back up to those levels. There's a really big resting offer at 165. I would be keeping an eye on that, and 164 as potential areas of resistance where prices previously run away, particularly from that 165 level. Let's take a look at Apple here. Apple sees a pretty big resting offer at 168, so that's going to be a level to watch, but a really larger one at 168.60, 102,000 shares on offer up there. So these are levels where you want to watch how price interacts, right? If you get a big push through and a larger delta bubble, that's telling you buyers are ready to absorb it. They've got plenty of demand. If you run away, that's telling you they don't, and typically you see reversals with that kind of price action. Meta has earnings tonight. Let's check on how it's trading, just around the 500 level and dropping from the open overall. Maybe a bit of hedging going on in this stock ahead of its earnings. Pretty high stake earnings tonight. Let's look at the semiconductor ETF. It's always a good measure of risk appetite in the current environment. Seeing that roll over a bit. We are trading below the point of control and VWAP, and we do have a decent demand level just below us. We'll have to see how price reacts to that. And Humana, I was asked about this one earlier. We can now see it's actually trading, so we'll just zoom in on that. We can see it just took out a pretty large resting bid here. So it seems like the path of least resistance for this one is lower as sellers show they have sufficient demand. Or I'm sorry, sufficient supply to overwhelm that bid, that demand that we see on the chart. Let's take a look at Dr. Copper as well. Continuing to overall look pretty good. It's consolidating after massive gains. This is one that I remain bullish on, especially if we start to see continued infrastructure spend, EVs sales, continuing, all these demands for copper, the growth of transmission capacity for electrification around the world. All these things are important in an environment where supply is constrained, both in terms of stocks, production, and also if we look out at exploration. And it takes a long time to bring a copper mine online, so we can't just flip a switch and get all the copper we need. Looks like that 5110 offer, so far sellers haven't been able to take us, or I'm sorry, that bid, haven't been able to take us below that bid here. So again, like with everything else, it is auction theory. We're really trying to get a sense of supply versus demand, and if either party has the upper hand. So I'm going to hop off mic for a bit. Appreciate you all tuning in. Hope this was helpful. I'll be back later, and I'll be streaming more about futures, stocks, and other markets, and providing commentary, talking about where I see opportunity. And as always, I welcome your questions. I enjoy interacting with you all. Appreciate you tuning in. We'll talk soon.